This wasn't an ordinary collapse. What truly happened was the slow breaking of people's trust, their lives, and their belief that the system was still functioning properly. The 2008 crisis wasn't a coincidence. It was the inevitable explosion of a massive failure built on years of accumulating greed, ignored dangers, and fake solutions sold as financial innovation. When the crisis hit, it wasn't just Wall Street that fell. People's homes, jobs, savings, and hopes collapsed with it. And do you know what hurt the most? The architects of this disaster walked away from the rubble even richer. If you were an ordinary person in 2008, your life probably flipped upside down before you even understood what was happening. One week, newspapers were reporting record-breaking housing prices. The next week, banks were collapsing one after another. Retirement savings were evaporating. The stock market was in free fall. And the government was pumping out billions. But to whom? Not to you, not to the workers who lost their jobs, but to the giant financial institutions that caused the crisis. When talking about the 2008 crisis, many people like to show off by using technical terms: subprime loans, credit default swaps, securitization, systemic risk. The list goes on. But when you strip away all that complicated jargon, what remains is a very familiar story. When money and power go unchecked, they repeat the same cycle over and over again. Let's go back a little. In the early 2000s, Wall Street was practically drifting. The tech bubble had burst, the economy was shaking, and major investment banks were desperately searching for a new source of profit. They found that opportunity in real estate, because owning a home in America wasn't just shelter, it was a dream passed down through generations. And Wall Street seized that dream and turned it into a massive money-making machine. It was during this time that the idea of packaging mortgages and selling them to investors emerged. Let's bundle thousands of home loans into one product, spread the risk and create stable income, they said. On paper, it looked brilliant, but the reality was different. To keep this giant machine running, they needed an endless supply of new loans. When qualified borrowers ran out, they started lending to people with weak or even non-existent ability to pay. Subprime loans, adjustable rates, no income verification loans. None of it mattered to them, because supposedly the risk was spread out. It was all one big illusion. There was another hidden side to all this. Behind the curtain, a massive gambling table was being set up. Credit default swaps. Investors were literally betting on whether these loans would fail. Some even hoped home values would crash, because the more defaults there were, the more money they stood to gain. Imagine a system where people profit from other people's lives falling apart, a system twisted from top to bottom. And the institutions supposed to act as referees, Moody's, S&P, Fitch, failed to do their job. They kept stamping AAA ratings on toxic products that were seconds away from collapsing in value. Why? Because they were paid by the same bank selling those products. Everyone was getting a slice of the pie, so no one dared to ask, where is this heading? No one spoke up until it was too late. By 2005, the housing market had long since left the realm of logic. Home prices soared far beyond people's earnings. Construction boomed, even in places where barely anyone lived. People were buying and selling homes they never intended to live in, thinking they had found a shortcut to wealth. From the outside, it looked like prosperity, but in reality, everyone was dancing on top of a massive bubble. And then, things began to reverse. As interest rates rose, people fell behind on their payments and foreclosures surged. Mortgage-backed securities started losing value rapidly. And like a row of dominoes, the entire system began collapsing, one piece after another. Lehman Brothers collapsed. Bear Stearns had already vanished earlier. AIG was the next giant on the brink. These weren't fringe institutions. They were pillars of global finance. And now, they were falling, one by one. Panic quietly spread across the entire financial world. Banks stopped trusting each other. No one wanted to lend. Liquidity froze. Markets turned red. Millions of people lost their jobs, their homes, their savings. And in just 1 year, Americans lost a total of $19 trillion in wealth. But the most painful part was this. The rescue packages were aimed not at the public, but at keeping the system itself alive. The government, backed by both sides of the political spectrum, funneled hundreds of billions of dollars to the banks. The Federal Reserve injected trillions into the system under the name of emergency intervention. And all this stability, who was it really for? Certainly not for the public. People continued losing their homes, unemployment soared. And the most ironic part, bankers used part of this bailout money to pay themselves bonuses. So instead of being punished, the very people who caused the crisis were effectively rewarded. What happened wasn't just an economic collapse. It was also a deep moral breakdown. It revealed the harsh truth that the system wasn't built to protect the people. It was built to protect itself. 15 years passed. The dust eventually settled, the chaos quieted down. But that massive system, it still runs. And now it's even bigger, faster, and, unfortunately, far more fragile. After 2008, central banks turned to their most powerful weapon, creating money. Quantitative easing, as they politely called it, was essentially this: printing trillions out of thin air and injecting them directly into the financial system. And this worked, as long as you were wealthy. Stock markets hit new highs. The housing market surged again. Corporate profits exploded. But wages stayed the same. The rich got richer. And the gap between the real economy and the financial world grew wider than ever. Then the pandemic hit. In 2020, the largest money printing wave in history took place. Interest rates were brought to zero. Emergency loans were opened. Direct cash was given to people. And for a moment it looked as if we had found a way to keep the system alive forever. But of course this wasn't sustainable. By 2021, inflation returned with full force. Price increases that were initially dismissed as temporary became permanent. Central banks raised interest rates sharply to undo their own excesses. Markets shook, borrowing became burdensome again. And the same cracks we saw in 2008 reappeared, this time even more visible. And do you know what the real difference is? This time the system is far more delicate, far more vulnerable. Corporate debt is at record highs. Governments are more indebted than ever before. Consumers have become dependent on credit. And the financial sector is more complex, more opaque, and far more dangerous. Crypto markets skyrocketed, then crashed. Fintech companies repackaged old traps under the label of innovation. But beneath all this noise, one truth never changed. The system survives on debt. Bad ideas are not allowed to fail. Regulators are often powerless or restrained. And when the cycle breaks, the cost is once again paid by ordinary people. So what lessons can we take from all this? First, complexity does not equal safety. The more complex a system becomes, the easier it becomes to hide risk. Second, incentives shape everything. Bankers take bigger risks when they know they won't be allowed to fail. Regulators look the other way when they expect their next job to be at a hedge fund. And politicians, fearing market backlash, choose to protect the system instead of the people. Third, financial literacy is no longer optional. It is a survival skill. We must understand how the game is played. We must learn to spot bubbles, question narratives, and always ask, who wins, who loses, and what happens when the music stops? Because the music always stops eventually. What happened in 2008 wasn't an anomaly. It was a warning. And today, if you look closely, you'll see the same architecture still in place, just more digital, faster, and far more fragile. When the next shock arrives, and it will, no one is coming to save you. There will be bailouts. There will be inflation. There will be volatility. But justice, don't expect that. You'll only recognize this once you understand what's happening behind the scenes. Real wealth is not money. It is knowledge, awareness, the strength to remain standing, the ability to sense the storm before it arrives. The system won't warn you. The headlines won't protect you. But history, if you're willing to listen, will prepare you for everything. History may not repeat itself exactly, But if you fail to understand it, it will crush you again and again. If this gave you a new perspective, subscribe. History always holds the answers, and I'm here to show you where to look.